Welcome to the extended version of Rooted Planning Group's Economic and Markets Outlook. Before we dig into the slides, I just wanted to give a little bit of commentary. Global markets pulled back again last week following the Fed's announcement that it would tighten another 75 basis points. Now that's as of this recording, so it may have pulled back even more than what I'm indicating in this message. Major indices are back to their June bear market lows, and S&P 500 fell 23% and the NASDAQ was down 31%. Bonds have also struggled significantly as all the interest rates across the inverted yield curve have jumped, and the 2-year Treasury has risen to 4.2% and 10-year is 3.7%, so clearly an inverted yield curve. This is the highest level since 2007 and 2010, respectively. Investors have been navigating this challenging market all year, and for many, it feels like there's no relief in sight. So you may be asking, how can investors see beyond recent market swings and short-term headlines in order to achieve their long-term financial goals? Well, in times like this, staying the course can be difficult. We understand that, but history shows that it is ultimately a reward. Nearly all investors understand that markets swing naturally on a regular basis and that the economy tends to operate in cycles. Still, this knowledge doesn't make it easier to avoid overreacting to large market moves. This is why, despite the importance of having an understanding of the investment analysis, financial planning, and portfolio construction, it often is our own behavior that is the biggest impact on achieving financial objectives. I understand that investors want to prefer to wait till the perfect time to invest. We never know when the bottom or the top is exactly. But sometimes if you wait too long, it translates into waiting until you feel comfortable to do so, and you've missed the majority of the rally. Looking at the moving averages of the S&P 500, you'll notice that there is a line that's crossing over. The 500 and the 100-day moving average at this point in time is crossing over. I'm sorry, the 50 and the 100-day moving average is crossing over. And you'll notice that the 50 is on the upswing. That could be a technical buy or sell signal. We really never actually know until after the rally or the further decline has happened. In reviewing the current stock market price to earnings ratio, you'll notice that we have come down from far from the peak in 2021, and that we're now trading at 16.8 times earning. The PE ratio uses the next 12 months earning estimates, which is our important indicator of when earnings are rising. This measure has improved due to the market correction, but we could see it continue to fall, and you can see the average historical is 15.5. As you can see by looking at this chart, investor sentiment is all over the place. You can see that in 2022, the bear bull market spread is pretty negative. This indicates that investor sentiment has swung wildly on a weekly basis, and it's also a contrarian indicator. When I see this kind of thing happen, to me, this indicates that there's probably a pretty good chance that we can buy into the market with some fairly decent deals. We are currently seeing a slowdown in the U.S. economic growth, but not at the pace that the Fed would like to see it with what we're seeing inflation rates at. You can see that the first and second quarter of 2020 were negative, although only slightly negative in the second quarter. Third quarter earnings news will be coming out relatively soon, and hopefully the Fed likes what they see and will slow down. Well, hopefully the inflation rates slow down and the economy is reflecting what the Fed has been doing, so that they will then be able to maybe slow down their process. As I mentioned in the short video, manufacturing activity has definitely declined from its peak, although non-manufacturing activity has not increased. excuse me, not decreased. And I think this is where the Fed is getting a little concerned, is that they're not seeing economic activity decrease in the non-manufacturing. However, we'll see what September numbers bring, and specifically October numbers. I think this might give the Fed some relief if we start to see this decline even more. You'll notice in some of the growth years that the unemployment rate and the core inflation rate normally are in a different inversion. So what I'm saying is that when you look at the recessions that are highlighted on here, unemployment is below CPI. Well, currently unemployment is significantly below CPI. That is an indicator, and it looks like it crossed over sometime in early 2022. As we look back on this, we may, highlight this area as an indication of potential showing that it was potential recession. But currently it is an inverted curve or inverted chart, meaning that CPI currently is higher than unemployment. When we see this crossover, there's potential to say that we're coming out of the recession, or that we're in years of growth, as you can see by this chart historically. One of the other projections that we look at is, what do we think companies are going to do in the future for earnings? So what is the next 12-month earnings yield? And as you can see by this chart, it has dropped below the average earnings yield that we have historically had, and is currently at about 6%. So that means that the forward-looking earnings and earnings price ratio is actually lower. So it's anticipated that things are going to slow down and companies are going to have less of a projected earnings, and the earnings to price ratio is going to be lower than the average. So that is an indicator that the sentiment is believed to be slowing down. We haven't seen that yet, but that's the projection at this point in time. We hope that you have found this information helpful. I realize it might be a week old by the time that you're listening to it, but stay tuned to the YouTube channel for more updated information. Please subscribe and like this channel, as we may do this on a weekly basis and more timely if enough people are interested in this information. So again, thank you for listening, and we hope that if you have any questions that you'll reach out to us, and we are here for you. Thanks, everyone.